We are obsessed with dates. We memorize October 1987, Black Monday, when the Dow Jones fell 22% in a single day. We analyze 2008, when Lehman Brothers fell and the global credit machine ground to a halt. We study these charts like maps of a battlefield, trying to find the why and the how behind the carnage. Therefore, we assume that when the next crash happens, it will start somewhere familiar. A housing bubble in Florida, a bank failure in New York, or a tech meltdown in Silicon Valley. But what if I told you that in every one of those crashes, historians missed the invisible thread that ties them all together? We've been trained to look at the Federal Reserve. We watch Jerome Powell's every lip movement, as if he is the only man at the steering wheel of the global economy. But the actual trigger, the pin that has popped every major bubble in the last 3 decades, did not come from New York. It came from 6,700 miles away, just as millions of tourists are currently rushing to Tokyo for their dream holiday, driven by a yen that has spent 2025 at historic lows. Global banks and hedge funds are rushing to Japan for a different kind of luxury, infinite liquidity. While the tourists are buying souvenirs, the banks have been buying the world, using borrowed yen. For the last 30 years, the global financial system has been powered by a single, infinite engine of liquidity. It is a mechanism so complex, yet so fundamental, that 99% of retail investors don't even know it exists. It is the reason your tech stocks reached valuations that defied gravity. It is the reason real estate prices decoupled from wages across the Western world. And it is the reason that, right now, as of late 2025, the entire global economy is walking on a razor-thin tightrope over a canyon of debt. That engine is called the yen carry trade. And for the first time in an entire generation, the engine is stalling. In this forensic analysis, we are going to expose the $20 trillion hidden position that Wall Street is desperately trying to hide. We will look at the mathematical certainty of what happens when the Bank of Japan is forced to raise interest rates. And we will examine the historical precedents of 1998 and 2008 to prove one thing. The next crash will not start with a bang on Wall Street. It will start with a whisper in Tokyo. This is the history of the future. To understand why the crash is inevitable, we have to look at the mechanism of the crime. In finance, this is known as the carry trade. Imagine, you could walk into a bank today and borrow $10 million for a 0% interest rate. Therefore, your cost of capital is nothing. Now, imagine you take that $10 million and invest it in something, anything, that pays 5%. That is a risk-free profit of $500,000 every single year for doing absolutely nothing. This is not just a theory. It is the exact arbitrage opportunity the Bank of Japan offered the world for decades. To fight deflation at home, Japan kept its interest rates at 0 or even negative, while the rest of the world had normal rates. Hedge funds, pension funds, and institutional smart money saw the greatest cheat code in history. They borrowed yen in Tokyo for free. They converted those yen into US dollars. And then they invested those dollars into US treasuries, which paid 4 or 5%, but they did not stop at treasuries. If you have infinite access to free money, why settle for a 5% yield? Therefore, Wall Street used this cheap Japanese liquidity to fuel the most aggressive bull markets in history. They used yen-funded dollars to buy Nvidia, to pump Apple, to fuel the rise of Bitcoin and the massive real estate bubbles in cities like Vancouver and London. Look at the correlation. When the yen gets weaker, meaning when it's cheaper to borrow and dump into the market, US stocks go up. It isn't organic growth or innovation. It is liquidity oxygen. The Bank of Japan has effectively been the shadow central bank for the entire world, pumping the air into a bubble that has grown too large to burst without destroying the room. But this mechanism relies on one critical, unspoken assumption that the yen stays cheap. That Japan never, ever raises rates. Or does it? History leaves clues for those who know where to look. If we want to understand the danger of 2026, we must look at the wreckage of 1998. In the late 90s, the world was in a similar carry trade euphoria. The smartest guys in the room worked at a hedge fund called Long-Term Capital Management, LTCM. They had Nobel Prize winners on their board. They had risk models that were supposedly flawless. Their strategy was simple: borrow cheap yen and bet on global bond spreads. Therefore, they were leveraged to the hilt, and for years, they looked like geniuses. But in October 1998, the logic flipped. The yen suddenly surged violently against the dollar. In a matter of days, the exchange rate collapsed from 136 to 111. This was not just a currency fluctuation, it was a systemic margin call. As the yen strengthened, the free loans LTCM had taken out became more expensive to pay back. Simultaneously, the value of the assets they bought with those loans was dropping. They were caught in a pincer movement. This created the doom loop. The yen goes up. The cost of the debt rises. Instantly, forced liquidation. Funds must sell assets, stocks and bonds, to cover the rising cost of their yen loans. Market panic. Asset prices drop because everyone is selling at once. Short squeeze. This creates panic, forcing everyone to buy yen to close their debts before they get even more expensive. Acceleration. The yen goes up even higher, restarting the cycle. In 1998, this feedback loop nearly vaporized the global financial system. The Federal Reserve had to organize an emergency $3.6 billion bailout of LTCM to prevent a total collapse. But today, the leverage isn't $3 billion. It's estimated at over $20 trillion. The Bank for International Settlements, the BS, recently warned of blind spots in a system, specifically $13 trillion in hidden dollar debt held via currency swaps. The leverage is 10 times larger, and the exit door is the same size. So why is this engine stalling? Why? Now, why, after 30 years of zero rates, is the Bank of Japan changing course? Because they have no choice. For decades, Japan's problem was deflation. Prices were too low. But in the post-2020 world, inflation has finally arrived on Japanese shores. As of late 2025, Japan's core inflation has stayed above the 2% target for over 3.5 years. The weak yen, the very policy that supported global stock markets, is now destroying the Japanese middle class. It makes imports of energy, food, and medicine prohibitively expensive. The Bank of Japan is currently trapped in what we call a checkmate scenario. Option A, save Wall Street. Keep rates at zero to maintain global liquidity. The result, the yen collapses, hyperinflation destroys the Japanese domestic economy, and the government falls. Option B, save Japan. Raise rates to defend the yen and the Japanese people. The result, the carry trade unwinds, crashing Wall Street and the global bond market. Politically, the choice is already made. No government will choose to starve its own people to save foreign hedge funds in New York. Therefore, on December 19, 2025, the Bank of Japan raised rates to 0.75%, the highest in 3 decades. This was the first domino. Every time the Bank of Japan hints at another increase, we see violent sell-offs in U.S. treasuries. But why treasuries? Because Japanese institutions are the largest foreign holders of U.S. debt, owning over $1.1 trillion. If interest rates in Japan rise, they have no reason to send their capital to America for a 4% return when they can get a safe, rising return at home. They will bring that money home. This is the repatriation of capital, and it is the sucking sound of liquidity leaving the Western world. But here is the most chilling part of this forensic puzzle. While the smart money has been quietly exiting the room, the retail investor is still being fed a mirage. Think about the psychology. For 3 years, you've been told that inflation is cooling, that rate cuts are coming, and that the market is unstoppable. Therefore, the average investor has moved further and further out on the risk curve, buying the AI revolution, buying the crypto moon, all while ignoring the foundation of the house. But global money foundations aren't built on Silicon Valley innovation. It's built on borrowed time. Remember the dance between context and conflict? The context is the 0.75% rate hike in Tokyo on December 19, 2025. The conflict is that the carry trade doesn't just stop. It collapses. When you borrow at zero and the cost moves to 1% or higher, the math doesn't just tighten, it breaks. You are being told that 0.75% is low, but in a world of $20 trillion in leverage, 0.75% is a lethal dose. It is the difference between a managed correction and a systemic margin call. The banks are rushing to Japan for liquidity just as tourists rush for souvenirs. But they aren't looking for a bargain. They are looking for survival. They are the ones who will sell your favorite tech stocks first, just to pay back a loan in a currency that is getting more expensive by the second. So, what does this silent crash actually look like? Most people expect a 2008-style headline about bank failures. But this will be a liquidity flash crash that does not bounce back. Imagine a morning in early 2026. The Bank of Japan announces a full exit from its negative interest rate policy and a reduction in its balance sheet. Within minutes, the yen spikes 3%. Algorithms, sensing the shift, instantly dump S&P 500 futures to cover currency exposure. The AI bubble, which has been funded by cheap liquidity, begins to deflate as investors realize valuations aren't worth the cost of capital. But here is the forensic detail you must watch: the bond market. In a normal crash, investors run to bonds for safety. Therefore, bond prices usually go up when stocks go down. But in a carry trade unwind, bonds crash too. Why? Because the investors who are underwater on their yen loans have to sell everything. They sell their stocks and they sell their bonds to get the cash needed to pay back the debt in Tokyo. Stocks down, bonds down, real estate down. This is the moment where diversification fails. This is the moment where reality beats expectations. When liquidity vanishes, everything with a price is sold to cover the value of the debt. And we are not just talking about a market correction. We are witnessing a regime change. For 15 years, we have lived in an artificial reality where money had a no cost. This allowed zombie companies to survive, allowed governments to borrow without consequence, and allowed stock valuations to detach from the reality of earnings. That era was sponsored by the Bank of Japan, and the sponsorship has been canceled. The smart money, the billionaires and institutional titans, are already positioning for this. They are not holding cash in banks that might freeze. They are accumulating commodities, hard assets, and defensive positions that can survive a liquidity freeze. The fuse is burning in Tokyo. The only question is, will you be holding the assets that vanish when the leverage unwinds, or the assets that remain when the smoke clears? Therefore, if you want to understand how to protect your portfolio before the Tokyo trigger is fully pulled, you need to see the next step in this forensic analysis. I've broken down the exact steps that billionaires take before every market crash in this video right here. And to understand why and how historical data suggests the market is still surviving as we enter 2026, click this other video right here. I'm the Macro Edit. Subscribe to see the patterns before they play out.